Welcome to 2022 StockOdds podcast, Odds and Ends with Dave Singh and Rob Friesen. Good evening, Rob. Happy New Year.
Hey, Happy New Year to you. Good
All
to
right.
talk to you again here. Hopefully had a good New Year's and celebration. I understand you're on the road and
I'm on location
checking out what
doing the show from Disneyland.
checking out what Mickey's up to.
From Tomorrowland, right? Yeah.
Or are you broadcasting from Tomorrowland? Okay,
Live
well that's
from
perfect for the you should have some real insights then. Real insights.
I know. I figure everyone gets a brand new chance, brand new year. Your P&L starts at zero. So why not start with some data-driven ideas behind it, right? But
What's your trading New Year's resolutions, right?
green, green, green.
Green, green, green. All right. So what do we have here for this week? Let me kick it off here with just a little bit of what's on the news calendar. It's not a heavy week, but we start off Monday at 10 with construction spending. That was actually November, so it's a lagging indicator. But are we booming in the construction area or not? Then Tuesday we have ISM manufacturing for December. Wednesday we have FOMC minutes. That's at 2 p.m. So we do have some movement. We do get movement off the FOMC, and the December meeting was important. So we can get a little bit of movement there. And then Thursday we've got 8:30. We got some initial claims and continuing claims, trade balance. 10 a.m. is ISM non-manufacturing. And then Friday, we've got non-farm payrolls, unemployment. And then at 3 p.m., we've got consumer credit. So that's the week. Light on the news, but some of the same things that we get all the time. Just another week, and of course, in Wednesday, you've got oil, and Thursday you got natural gas, right? All important. Okay. One other tidbit here. I saw somebody put together an article on 2021. The S&P 500 beat the Dow and the Nasdaq both, which is only the sixth time in history that it's happened. And so the returns after that are muted. No, not as robust as what we've seen in 2021, but 70% of the time we're up, and on average, I think 7.7%. So it looks like, the deck is sort of stacked towards a bit of a follow through year. And of course, we've got the opposition to that being, any new surprises. How does this? I think the problem with the Omicron is not that it's that bad compared to Delta or the original COVID initial strain in terms of symptoms and hospitalization and death and so on. Maybe it's not that bad, but here's the problem: we've kind of pigeonholed ourselves in developing all these protocols for the original and for Delta, and you take the Omicron into the same protocols, and what do you have? You've got, like, if just about everybody's going to get Omicron, you have a serious problem in terms of, people not being able to function and, perform their duties and go to work and all the other things and that's why they've changed the, 10-day quarantine down to 5 days. I mean, you gotta ease the pressure, and so that's the big risk there, that things can be bottlenecked and shut down and disturbed, and a lot more people off work or impacted by this, and so just when we were sort of rebuilding and coming back and opening up, then you're hit with this. So that's the problem. We're kind of pigeonholed. You know what I mean?
Yeah, it's like the if-then statement was made 2 years ago for a fatal. It's like, if you get it, you're almost dead, right? So there was such severe, extreme lockdowns and quarantines and restrictions, but they never went away. So then people still have those extreme
right.
if-then statements in place, and then now it's a milder form. But
well, and they do have to reform them, right? I mean, because it isn't as severe, and it's going to be more endemic, and it's not to be compared exactly with the common cold, but you know what I mean. It's going to be more common in its occurrence. So if you have those same protocols in place, like you have automatically got a quarantine, and originally it was 14 days, and then 10, and then 5. And the contact tracing and all the people that have been impacted. If you were to continue that same thing, I mean, there wouldn't be anybody let out of their house.
Yeah.
So in the sense, there is impact to our economic condition and society's flow. So, all right. Just running through where we are with the futures here, and then I'll let you get to some of the groups and stuff. So what I see is, before I so rudely lost it here. Okay.
The futures are up about 0.4% on most of the indexes, with the Nasdaq leading almost 0.5%.
Yeah.
So it's just risk on, money being redeployed, which is natural. First day of the month, first day of the new year. So that risk on, and the fact that it's so evenly dispersed, it's just like money coming back to
Nasdaq's up. Yeah, Nasdaq's up the most right now. But the thing is, they did rally a little bit more, and they've pulled back off that high. So the futures opened, gapped up a bit, roared, and then pulled back off the highs. And that's the same. Like the Nikkei did the same thing, and the Europe futures as well, also doing the same sort of action. So it seems world markets right across the board sort of lifting and getting a little bit ahead of themselves and pulling back. So we'll see how it is by the morning. But, think about right now, everything sort of up about, 0.5% on average. Mm-hmm. Okay.
Yep.
All right. How about the groups? What do we got for? Because this week we got a full week, no holiday, except I think some markets are still off, like Canadian markets are closed. I don't know, European markets, we have to check on that.
Yeah,
but
I went back to
some institutions offline, right, still for Monday. But so expect a little bit lighter volume, and especially after coming, off of a important weekend. The kickoff of the year, there still may be lighter volume, less parties participating. And then Friday, we do have the first Friday of the month, so we have some visibility into seasonality there. Okay, take it away.
Yeah, so I'm using the Seasonality Almanac screener. That's the free screener available to anyone. And just typed in the first day of the month, January, and to see what sectors were showing up with better odds. And some of the interesting things we found were gold, silver expected to do well, typically, and then things like oil and ARK-K. So ARK-K, SMH, and things that are expected to perform poorly are XLU, so utilities, real estate, staples. So it's just general risk on with a little more emphasis in tech and more high beta names. Then I went a little bit more granular to see which stocks would show up for the first day of the month using the screener, and things like Plug, CRISPR, Edit, Blink, a lot of the solar stocks, First Solar, Enphase. So it's higher risk tech stocks showing up as possible leaders.
We've had some problems recently with the solar and the whole, environmental.
Well, the last time we had strong solar odds, there were a lot of regulatory changes that are in the works in California. So that kind of like superseded what the stats would have shown.
Right.
But for starting off the new year and the first day of January, these are what the data shows.
Yeah, so normally at this time of year, there's sort of the expectation for a greener future. So what might be disrupting that right now You know, we still have some of this headwinds on the all the plans, like the Build Back Better, everything like that.
Mm-hmm. That's right. And then I took a little further to look at some of the sectors versus each other. So things like small caps versus the S&P. So IWM is expected to do slightly worse than the SPDR. SPDR is expected to be minus 0.16 and the IWM at minus 0.4. So a little bit weaker for the small caps. And then I checked like QQQ. So Nasdaq is expected to do a little better tomorrow relative to the SPDR. And things like SMH.
We see that right now in the futures. We see that Nasdaq's got that leadership. So okay.
SMH is expected to do outperformance almost 0.5%, plus 0.46 for the SMH versus minus 0.16 for the SPDR. So so semis would be a really strong one, and a really outperformer would be TAN. It's the solar ETF. That one is expected to be up 2.43%.
Interesting.
So was the strongest of the study. And then things like ARK, again, that's expected to be up plus 0.79 relative to the SPDR, which is expected to be down. So these high beta, high growth things seem to be better odds based on the data. And then even like discretionary, it's supposed to be slightly up versus the SPDR to be slightly down tomorrow on an open to close basis. So again, it's just risk on. It all makes sense too. It's logical, like what money being redeployed, leverage going back up, right? So nothing seems out of the norm. But who knows? People have a lot of gains baked in from the previous year. How much of that are they willing to start taking off the table? Right? They didn't want to lock in profits in December, but who knows how much of that they'll do in January.
Mm-hmm. Well, it's interesting what we've seen for the whole year, you know, and the argument, will the best performers of last year continue into the new year, or will we see, you know, reversals, right? So looking at the sectors, let's just look at our year-to-date performance. So consumer defensive and consumer cyclical were up almost 7%, but the worst performers of all of the groups. And the best was energy, up 36.98, real estate next with 28.1, technology 26.86, financials 21.41. So the financials really benefited from the prospects of rates moving higher. So would you focus on that in the next sort of 3 months as we anticipate maybe the rate hikes to start in April?
Yeah, I mean, the easiest would be financials, right? If a 10-year is going to be gradually going up, and even to a natural level over a historical basis, it's much higher than here. So that one has the financials have the most wind at their back without doing anything. Energy is trickier, and there's so many more influences that go into why it's going to go up. But and it's had such a huge year this year, right? So can it continue after a plus 37% run?
Right.
And then real estate again. I just think financials have it's like the easiest trade, right? Technology, things are priced richly. That's where the most growth will be. And then are we going to be in defensive posture with utilities and staples? I don't know.
Well, I mean, we note to our listeners here that, you know, since consumer, cyclical, and defensive and utilities have underperformed energy, real estate, technology, financial this past year, you know, it really overall was a risk-on year. We only really started to falter a little bit, you know, in September, and then again a little bit in November, December. So otherwise, pretty much characterized as a risk-on year, with obviously, you know, the SPY performing better than the diamonds and the Qs and stuff. So carrying that over, if we do start to see some real shock waves hit, it could be a completely different catalyst. It might not even be anything to do with the pandemic anymore. It might be something completely new that comes along. And again, we start to cycle to that risk off scenario. Then remember, the things that have been the most discounted and would have the opportunity, because money wants to rotate a little bit more than leave the market completely, because where else are you going to go to get, we're in still a very low interest rate environment to negative real rates. Where are you going to go? So I would say some of the technology money and maybe real estate money could roll into consumer defensive, consumer cyclical, right? And utilities. So just keep that in mind.
And then on a market cap basis, I'm looking here. Again, mega caps were up like 25% for the year, but small caps were up only 14%. And we had a run early on in small caps, but it was flat for most of the year. Mm-hmm. So, and you would expect it to do well from November till, was it next May or April?
Yeah.
They really
even like the 1 month and the 3 month. It's nothing to write home about with Russell's performance. It's really been lagging what it normally should do.
Yeah, and it's mega cap it's a double-edged sword, right? They get the growth and they get the safety in the same instrument. So I don't see how that's going to be changing. If people have a little more hesitation, they're going to still stick with the mega caps, and if they want to be risk on, they're going to go with mega caps again. So I think that mega cap could really continue to persist relative to small caps.
Mm-hmm. Yeah. Well, that's where the flight to quality is. Okay. Yeah. Now, how are we doing on some of the commodities here? And of course, the US dollar always needs to be mentioned. So the US dollar was in a bit of a channel for December. It's kind of sitting right on the low end of that channel. Looks like the last day of the year, it just popped up a little bit there. So yeah, it's got a bit of an air pocket if it breaks the 95.50 area. Looks like it could head back down a little bit. So keep an eye on the dollar. And what do we got going on with? Do you think this will be the year that gold or silver comes back?
Silver was down 27% for the last year, and gold was down 7%. And the useful metals like steel was up 38% and aluminum up 73%. So, that's the environment.
Hey, why don't you make a prediction for this year? Which is going to perform better, Bitcoin or gold? Everybody, human nature. Everybody wants to predict what's going to happen this year. we don't know, right? We'll take it one odds day at a time.
Yeah.
So anyway, very interesting. Okay. Anything else newsworthy out there?
No, I nothing newsworthy.
We have China Evergrande shares are halted for trading now. So didn't mention the reason why, but obviously we know nothing good going on over there. So I don't think China's story is over yet, and we saw a recent last week rally back on some of the China stocks, but I would just be still very cautious. I don't think they're out of the woods in a lot of areas in China yet. So
I saw something that Singapore had better than expected GDP too. So it's like the world is going back to business and functioning, and even if everyone has a mask on, commerce is happening, business is happening, and it's pent up. So with that pent up kind of demand to do everything at your back, that risk on for the whole year could be pretty good.
So we still have the Ukraine situation. It's they've had some discussions, but I don't think that saber rattling is going to be over. And then we've still got the Taiwan issue as well. So it certainly could be something that comes into play in the new year. All right, well, we'll let you go. Thanks for chatting here, and good trading tomorrow.
All right, back to Tomorrowland. Thanks a lot.
All right, take care. Thanks.
Bye-bye.